What if our AI bullishness continues to be right? And what if that's actually the most bearish thing that could happen? Right now, the world is locked in a silent arms race to build the most intelligent systems in human history. Governments, corporations, and startups are pouring trillions into compute, models, and automation. Everyone assumes this ends the same way technological revolutions always do: higher productivity, more wealth, and a better standard of living. But what if this time is different? What you're about to hear is not a prediction, it's a scenario. A thought experiment developed by Citrini Research known as the 2028 Global Intelligence Crisis. And its core warning is unsettling. The very technology we believe will save the economy could be the thing that breaks it. This crisis isn't about killer robots or AI rebellions. It's far more mundane and far more dangerous. It revolves around something called the intelligence displacement spiral. Here's how it begins. Starting around 2026, companies adopt AI aggressively, not as a productivity tool, but as a cost-cutting weapon. At first, the results look incredible. Headcount drops, margins explode, earnings calls sound euphoric. Equity markets celebrate. The S&P 500 pushes toward levels people once thought impossible. The Nasdaq levitates. Executives do what rational executives always do. They take those profits and reinvest them into even more AI. More automation replaces more white-collar work. Analysts, developers, marketers, designers, legal researchers not eliminated overnight but compressed. Roles are downgraded. Salaries fall. Fewer humans are needed to produce the same output. And that's where the system quietly starts to break. Because when humans earn less, they spend less. And when spending slows, an economy that is nearly 70% consumption-driven begins to suffocate. This creates what economists are starting to call ghost GDP. But the wealth flows almost entirely to the owners of compute, data, and models. Machines produce, humans don't get paid. And machines don't consume. You end up with an economy that looks healthy from a distance but feels hollow up close. Storefronts are open, apps are running, services exist. But fewer people can afford them. That's ghost GDP growth without demand, prosperity without participation. So how do we know when we've crossed the line from healthy automation into the danger zone? The first fracture appears in software. By late 2025, if a single skilled developer armed with agentic coding tools can replicate an entire SaaS product in weeks, pricing power collapses. Software stops being scarce. Contracts get renegotiated. Seat counts shrink. Revenues flatten, not because demand vanished, but because one human plus AI can now replace entire teams. The second signal is what some analysts call the ServiceNow moment. That's the day a major enterprise software company openly admits that AI is hurting its own revenue because customers no longer need as many employees or licenses. When a platform designed to manage human workflows starts losing money because there are fewer humans left to manage, the loop is complete. The third fracture hits the financial plumbing. By 2027, AI agents don't just recommend purchases. They manage them, they cancel subscriptions, they price match everything. They route payments through stablecoins to bypass fees. When machines start optimizing spending on behalf of humans, consumption becomes frictionless and significantly smaller. That's when velocity collapses. If this spiral continues unchecked, 2028 doesn't look like a recession. It looks like a regime shift. Unemployment pushes past 10%, not because work disappeared entirely, but because high-value work did. The stock market, after years of AI-fueled euphoria, drops nearly 40% as earnings expectations reset. Labor's share of GDP, once the backbone of the middle class, sinks toward levels not seen in modern history. But the real black swan isn't stocks, it's housing. The U.S. mortgage market, roughly $13 trillion, is built on one fragile assumption: that human income remains stable over decades. 30-year loans only work if skills stay scarce and valuable. AI breaks that assumption. When intelligence becomes abundant, it stops commanding a premium. This is the collapse of the human intelligence premium. Even borrowers with perfect credit, especially in tech-heavy cities, find themselves exposed. Not because they were reckless, but because the economic value of their cognitive labor eroded faster than their mortgage amortized. Home prices soften, defaults rise. And suddenly, what looked like a productivity miracle starts to resemble a balance sheet crisis. So is having too much intelligence a bad thing? For society, no. For an economy designed around scarcity of thinking, yes, unless the rules change. The challenges are obvious. Wage compression accelerates as displaced white-collar workers move into lower-paid roles, increasing labor supply and pushing earnings down across the board. Financial stress spreads into private credit, pensions, and insurance products that quietly assumed stable employment would always exist. But crises also force change. This scenario could trigger entirely new frameworks, direct transfers, public ownership stakes in AI output, or legislation that treats intelligence infrastructure the way previous generations treated land or oil. A system where AI-generated wealth isn't owned by a narrow few, but shared because it replaces a shared human capability. And here's the key point. If you're watching this in 2024 or 2025, the canary is still alive. You still have time to stress test your career, time to examine your investments, time to ask whether your assumptions depend on human intelligence remaining scarce, expensive, and indispensable, because that assumption may not survive the decade. For centuries, the bottleneck in our economy was thinking. Now, the bottleneck is spending. The question isn't whether AI will get smarter. That part is inevitable. The real question is whether our economic systems can survive its success. So what do you think? Is this just bear porn? Or is ghost GDP already haunting the system? Well, that's all for this video. Remember to like this video and subscribe to our YouTube channel as your support motivates us to do better. Thank you for watching, and we'll see you again in our next video.